Okay, return on investment. As we look through this section, you will see that pretty much the top level details that are relevant to the financial performance of the product is provided here. So if I am part of the audience, if I'm the board member, I'm looking at this and I'm saying to myself, okay, this is more or less what you as a product manager is committing to the company if I fund this product development. And so it is that serious in the sense, as a product manager, you are pretty much committing your refined judgments, your sound analysis, and you are prepared to answer any questions and back up your answers with the data. And so let's do this. Let us again take a closer look at this, and I want to analyze. I want to just go over some of these items and see how they are related to one another, and how this leads us into the next lecture of market analysis or sizing of the market. Okay, so the first element here in the return on investment is, once again, let me just say this: return on investment is saying, okay, here is if I'm the product manager, you're saying, a company, so I'm requesting the company that here is how much return on investment I think is very much possible with a high degree of confidence if, as a company, we fund this product development. That is basically what that return on investment is. And then first element here we say is that projection assessment period. And example here goes from third quarter 2014 to second quarter 2017. And it says 12 quarter. That is a very typical and expected projection. Now, when I say projection, what I mean by that is basically, let me show you this picture. So basically what you are saying is assuming that the product will be launched and made available in the market in Q3 or beginning of Q3 of 2014, you want to show the company the performance of the product, the financial performance of the product, the revenue potential of the product as it moves through the market for at least 12 quarters. 12 quarters is a typical, you don't have to go anymore unless you are being asked. 12 quarters is 3 years, and typically 3-year projections seem to be more acceptable norm. And so you say that, first of all, right off the bat, you're saying that assessment period is 3 years. And then you're saying that the total licenses sold or users acquired is 50 million units. And so the way so basically what you're saying is, okay, so in this projection, during these 12 quarters, the consolidated cumulative licenses sold, if it is a software product, or users acquired, maybe it's some sort of a network, social network type of thing, whatever may be the metric, you are saying that there are 50 million units that are guaranteed to be brought in by this new product. And total revenue as against this 50 million units, again, total revenue is within this 12 quarter period. You're saying there's about $47 million that the company can make as a revenue. This is not profit, this is not income, this is just the revenue, which is the sales revenue. And this is again the consolidated, put together all 12 quarters. There may still be revenue after the 12th quarter, but a bulk of the revenue you're pretty much covering within the 12 quarters is what you're saying. And overall gross margin as in product gross margin, basically everything that you take the sales price and then take the cost of making the product, and then and what's remaining is the gross margin. There's a formula how you calculate that. We can get to that. And then what you're saying is average selling price per user is, it's probably a mobile web app or what have you. It's a little less than $1. And you're saying that right off the gate, when the product is made available, it is about 94 cents in Q3 of 2014. But that, for various reasons that you will probably justify, that ASP or the price is going to fluctuate a little bit. And then as you go towards the tail end of the projection period, you are probably going to see that price come down, or maybe it is part of your strategy to reduce the price over time. And then you're saying the total development costs are about $5.8 million. Now these development costs are the upfront or even continuous, if there are any development costs before you launch the product. And then that you're saying is 6 million. And then duration for development, it takes about 9 months, and you've set exactly what the months are, February 2013 through October. And the last point is break-even point, return on investment is equal to 1. Basically what you're saying is that in ROI is 1 in Q3 2015, is that when you hit Q3 of 2015, you're going to start to begin to make money, meaning return on investment. If the return on investment is 1 or more than 1, that means you're getting more revenue over and above what you have already put in as a development cost. If the return on investment is less than 1, obviously you have not recouped your development costs yet. You still have to wait for a few more quarters. So that's the logic. So what I want to show you is show the same thing what I just described in a visual format, because this is how your financial charts in detailed files or pages or presentation are going to look like. So here, very nice 2014 through 2017, 12 quarters of the calendar of the period, and each curve here essentially. So if you start with, for example, as the table shows, the total licenses sold, or which is the unit sales, you're showing a curve which starts very low at Q3, and then it sort of ramps up, and then somewhere around Q3 and Q2, Q4 of 2016 it peaks, and then it starts to either flatten out or come down in the following quarters. In general, most product sales reflect this kind of a curve, because as you reach the tail end of let's say 12 quarters, or whatever is the projection period is, you are already planning for your next product, and you're already ready to launch your next product. And so maybe it is in your company's interest to shift your customers from this product to that brand spanking new great product that you will put out 2 or 3 years from now. And so in general, you will see this kind of a curving down or flattening out of unit sales. And so ASP, for example, you want to sort of try to maintain it as a stable ASP, so you don't fluctuate it too much. And you did say that it's going to trend from one period to another, so I'm showing this as ASP going down slightly a little bit as you go towards end of 2016 and 2017. And the most important, I guess the point I want to highlight is, you see the development cost. The development cost is, you company invests a lot of money, about $5+ million upfront, and all that money is going into buying tools or hiring a development team, or putting in the work. And as you get to closer to product development completion and ready to go to the product launch phase, the development costs will come down, and maybe there is a residual development cost that keeps on. And then there's another curve is, and the revenue starts to ramp up as you start to market and sell the product, as beginning of 2015. So you look at the ROI curve. In the ROI, return on investment, I think it's probably a very simplistic way to draw it, but the point is that the return on investment at some point before you actually start to get the revenue is going to be less than 1. It is not something that you're not getting any return. You know, return on investment is your investment is bigger and bigger, but there's no return yet. But as you get more and more revenue, you will see that ROI will hit that crossover point of 1, and then will start to grow, and then at some point it'll taper off. And now the question is, what is that number return on investment will grow to? Is it 2 times, 3 times, 4 times, 5 times? Depends on your projection, your product's value, the product's pricing, the market situation, and also how reasonably you have made this projection. Obviously, the temptation is to show a very big return on investment as the product peaks, but I think the reality is usually markets tend to follow a sort of a reasonable adoption, and so you want to be very rational about how you project this. And so this is how you are going to walk through the entire financial presentation in terms of the details that you will put into the finalized financial return on investment business case. And so what I want to do next is I want to pick one element here in this business case, which is the unit sales. And I want to develop this, and I want to ask, now that's the goal. Now we have seen the well-developed business case, a summary of it, and a little bit more detail as to the 12-quarter trending of it. And now I want to see, how do I get here? How do I get to this stage? So let's pick one, unit sales. And let's use that as an exercise. So if for the unit sales, as in the next lectures, what I'm going to do is we'll start with to get to unit sales, you have to start with a set of market analysis tools and a set of thinking tools, a set of mindset, so to speak, in interpreting this data, whatever market data is. And so in the next lecture, I'm going to switch to that market analysis. So in that topic, we are going to touch upon terms such as total available market, serviceable addressable market, SAM, total available market is TAM, and share of market is market share, SOM, SOM. And so that way, when we are dealing with all these market research terms, market share terms, we know what the end goal is. The end goal is you want to go towards what our projected unit sales of our product will be. Okay, so we'll see you in the next lecture. Okay, thank you.